Dividends are considered a major contributor to your long-term investment return, delivering between 60 and 70% of your total return over a 20-year period. Joining us at the desk to discuss the importance of dividends are Mark Thomas, Head of Business Development at Grindrod Asset Management. Mark, thank you so much for joining us on this chilly day here in Johannesburg. So let's get your very, very broad view on the role that dividends plays, because there we said 60 to 70% of returns over a 20-year period. Why? In simplistic terms.
In simplistic terms. Well, you see, if you take your long-term return equation, which is really your initial dividend yield, your starting point, and how fast those dividends grow, you add those two together and you get your total return over the long period of time. In the short term, the short-term price movements completely mask the effect of dividends in a portfolio. But over the long term, if you've got a substantial starting yield, that makes up 60% of your return. You've got it in the bank, you know it's coming, and you can plan around it, especially from a personal finance point of view.
Yeah, I think maybe if I jump in there, I fancied myself as a day trader in the early days, and I thought you could make some nice money, and then that didn't pay out. And in fact, one of the things that irritates me the most is I've got the stockbroker that I'm with basically has a running total at the top, and it's always sitting in the loss. So while you think you're very clever and you're always making some money, of course you never tell anybody about the times you lose money. You forget that capital gains often are only a very small part of the overall equation. And instead of trying to day trade and convince yourself that you are smarter than the market, I think the one thing is you find dividends are just fantastic. There's nothing better. You used to get a notification every time your dividend came in on a Saturday morning saying dividends in your account, and it's money for jam in a lot of cases.
So it's important, obviously, then just to reinvest your dividends and see that capital appreciation.
Yeah, and it's also a symptom of the fact that there's no yield in the current world, and investors are going out looking for things that are going to earn them some sort of income return over time. And we've seen some great dividends from Imperial. Spur pushed out a nice one yesterday, and it's something that's quite accessible to the retail investor as well. You've got Satrix Divi Plus, and you've got the Sanlam Divi Plus equivalent, and you can access those funds quite easily, and it's a nice way of knowing that, as Mark said, you're not only reliant on capital growth in the underlying share, but what that company is actually going to pay you back.
Are there any broad ways to characterize the type of firms or the type of companies that are usually strong dividend payers?
Well, they tend to have very established markets. They tend to have very strong balance sheets, so that in difficult times they can continue to pay the dividend to the investor and even grow the dividend. In the States, they've got an index called the Dividend Aristocrats, which for every year for 25 years have grown the dividend. So they tend to be the large established companies. They tend to be the companies that people turn to in times of crisis, like we had in 2008. So you'll find with those dividend payers, the consistent payers, over the long term, they actually outperform the non-dividend payers or the dividend cutters in any portfolio. And in downward markets, they also tend to outperform, so they provide a bit of a shock absorber in your portfolio as well. But I think the most powerful thing is the compounding interest story that you mentioned. If you compound those dividends over a 20 or 30-year period, you'll have twice as much capital as you would have had if you hadn't have compounded those dividends. So the income return on your investment is just as vital, if not more, than just the slow but sure capital growth over time. And
you talk about ETFs. Are these the best ways to be able to get exposure to nice juicy dividends, or should we be stock picking?
It depends on you. I'm a fan of unit trusts because my feeling is there's no way I'm going to beat the Coronations of this world. So I don't like to pick particular stocks. I like to outsource that function to an asset manager that I trust and I like. But there's no harm in phoning a broker or working through your financial advisor and getting some decent advice and bouncing it off guys like Mark and seeing what they say. As I say, for me, unit trust is a nice sort of easy way of entering into it and allowing someone else who's far cleverer than you to do the tough work.
Yeah.
May I just add to that, if I may, Mark, is that what's very important in this equation, though, is that you've got to be in the share. If you're not in the share over a long period of time, you don't earn the dividend and you can't compound the dividend.
Yeah.
So it's not a trading mindset that you've got to be in if you're going to be in as a dividend growth investor. You've got to be as a long-term investor, collect the dividend, either spend it if you need it, in retirement, or you compound it if you're saving for retirement.
And that's where the returns really come in. It's the compounding factor.
Yeah, I mean, you can use the example of McDonald's in the US. Now, I mean, in general, we hate the concept of McDonald's, but McDonald's is a fantastic business, and I stand corrected on the exact stats here. But $1,000 invested in McDonald's when they originally invested, and when they originally listed, never touched them again. I think they're worth today $1 million. And that is simply because of the reinvestment of the dividends, the dividend split, the share splits, etc. And that's buying into the concept of a really cool, powerful business that's simply grown over time. I think you can see some of the things with PSG, Remgrow locally.
I think one of the best ways to illustrate that is something Mark actually said to us the other day, and correct me if I get this wrong, but I think you said that if you stripped out the 20 best days of a stock, and you weren't in that stock in those 20 days, you'd lose something like half the value of that you could have had if you'd stayed in there over time.
Yeah, so you've got to be in it to win it, as they say.
Yeah.
So in the market, if you want to collect the dividends and compound them, and you want to get the best days of the market over a 20-year period, you've got to be in it.
Okay, so let's talk about some of the stocks specifically on the local market right now that stand out as strong dividend payers. Anything that comes to mind?
Well, the two that spring to mind are just the few I've seen in the last week, Imperial and Spur. Spur, nice cash generative business. I don't want to say too much because I'm going to be writing an article on them, but they've consistently delivered, and it's just I think touches on what Mark said. It's a household name in South Africa, a strong business. It's been around for a long time, and if you're a conservative, cautious investor is looking for something that won't let you down, most analysts will tell you Spur is not a bad bet.
Yeah, and I think also maybe building on that, I mean, I think you've got to strip between the property sector, and I know Mark's got some comments on the property sector itself, but property's been a fantastic asset class. You've got good after-tax, a real after-tax return, but then a lot of the good dividend payers often tend to be quite cyclical. You can use the platinum as an example. It's very much boom and bust. I mean, there are years or cycles where the platinum companies pay 6, 7, 8% when you're buying it. At the moment, the platinum companies are nowhere. Their dividends have been stripped out. Remgrow has always been.
So that's also another factor, volatility in dividend payments,
Correct.
And the fact that I mean, remember when Anglo American cut their dividend, the huge outcry, how do you see that coming?
Yeah, you don't, and I think, look, the business cycle in the last couple of years has been warped, to say the least, and I think it's very difficult to go and say, I mean, Anglo American, Old Mutual, I mean, these are big companies, and they had real cash issues that they had to try and manage those balance sheets. I think you always want to look for the companies that got strong cash flow statements. And I think, FirstRand's another very good example of something that's consistently returned to shareholders. And I think the questions we often get are from the guys looking to trade the smaller cap businesses, where they'll have a good dividend, they'll have 1 year where there's a good dividend, but the moment that the cash flow dries up in those businesses, it becomes much harder to look at. I mean, one example is ISA, the tech company. They have consistently paid 5% dividend yield for the last couple of years, and yet you don't get any real capital gain there. But you've got to be looking at their cash the whole time. They have one bad year, and there's nothing to maintain that history.
Let's get into the property sector, because you of course manage two funds, the one PESA, the other Endurance Funds, and there's an article that you guys wrote in FinWeek this week called "Reframe the Trend," be aggressive, and basically these funds very much geared towards equities and property. So let's talk about property stocks in light of distributions.
Okay, well, first, just a small correction. I don't manage those two portfolios myself.
But you're from Grindrod, who manages them.
My
there
colleagues
we go.
Ian Anderson and Jeff Noble manage them, but in the team, I participate in the asset management of the team. But yes, I think there's one word that you use there that makes me a little bit uncomfortable, is the word aggressive, because the way that we look at putting portfolios together, especially bringing property in as a high weighting into a balanced portfolio, is that we're looking at the objective of the investor, the outcome of the investor, not at the short-term price movement or volatility of that asset class. And as soon as you do that, you start thinking very differently about how you're going to achieve that objective. And in this low growth, low return world that we're all assuming is going to happen over the next 5 to 10 years, outperformance is going to be very hard to come by, number one. And number two, getting inflation plus 3 and 5 is going to be extremely difficult to achieve. With most balanced funds being at 50 to say 65% in equities and the balance in bonds, it's going to be very, very difficult for that kind of balanced fund to get to inflation plus 3 to 5. Bring listed property in, which gives you a great starting yield of around 6.7% currently, which is higher than the current inflation rate. it grows its income stream above inflation, and you're looking at inflation plus 5 to 7 from a listed property security over a 5 to 7 year period. Add that to equities, and now you're very much in the range of achieving your objective. Yes, you have to accept short-term volatility in order to achieve that, but that's not necessarily risk for the investor, it's just volatility.
What are your views on big exposure to listed property in a balanced fund like they have here?
Well, when I first looked at the fund fact sheet and I saw that I think both the funds have a listed property exposure in excess of 25%, I was quite surprised because I like balanced funds, and normally the exposure to listed property is between 4 and 6% roughly. So I was quite surprised, and obviously asked Mark, please tell us the rationale behind that. And it's, as he just said, if you want to get long-term income and growth in your fund over time to beat inflation, you have to take a bigger exposure to equities and properties because those two asset classes have been proven time and again to deliver over time. Where I stand is, I think, probably the best way of explaining that is again something that Mark said to us in his explanation, is that on the surface of it, it might look more risky to the lay person sitting at home going, why am I putting this amount of my money into listed property? But it depends on how you define risk. And if you define risk as short-term volatility in your funds, well then maybe it is a bit more risky. But if the real risk is looked at, do you or do you not achieve your retirement objectives over time, then it's not actually risky, because that is really the real risk in all investing, retiring one day and realizing you don't have enough money in the bank.